With the S&P 500 and the Nasdaq turning negative, you can also see Microsoft shares themselves down about 2.2%. I believe Nvidia was down in the pre-market. Let's take a look at what Nvidia is doing in the cash trade. It is also off about 0.8 of 1%. Let's bring back in Truist CIO and Chief Market Strategist Keith Lerner. Keith, you were just talking about with Danny about this, and we don't see huge moves in companies that have come so far so fast, certainly Nvidia, but there is kind of a shift in leadership even within the Mag 7. What's your take on the TPU versus GPU discussion?
Well, I think, one, there's just a huge amount of demand in this space still, and there's going to be more competition. Nvidia's had this big lead, and, other companies like Google are coming in, and, it's still obvious that I think Nvidia has the lead, but they have these huge gross margins, and it makes sense that, these other companies with big balance sheets are going to try to come after that as a whole. So, I think what you're also seeing as a result of that is you're just seeing, within tech, you're seeing this kind of big dispersion. So it's not monolithic trade anymore. And that's where, fundamental work does help. If you look at the Mag 7 this year, what's interesting, only 2 of the 7 stocks of the Mag 7 are actually outperforming in the S&P. But the ones that are outperforming this year are outperforming by a big margin, which is lifting the overall market. And I think that's what you have to keep in mind. Like, not everything's going to work, but the ones that work, if you can have big gains, it's almost like venture capital that they can often offset some of the losers.
Well, Keith, this feels like a key way that it's different from the dot-com bubble, because back then it was kind of, I guess, straightforward or easy to understand what the internet was, what a website was, maybe the promise going forward. But this time it's different. To Matt's point, it's trying to analyze what TPUs versus a GPU, what AI data centers are being built up and who has leases and who doesn't, and what the technology means and how you get revenue returns on it. It feels deeply, deeply complicated. If you want to have alpha and do better than just beat the overall market, do you all of a sudden need to have a knowledge base that is that of an engineer? How do you gain knowledge and gain edge when it is kind of confusing to the everyday person?
Yeah, no, it's a good point. And that's why we also have on our team, specialists in the technology sector to help us guide us through. A lot of us as strategists, we're more generalists, so we have to rely more on the analysts that are doing kind of, the deep work on that side. But the other thing, if I try to keep it simple too, if I kind of zoom back from a macro picture, what we focus on, especially with tech at large, is their earning trends, and not just the earning trends on an absolute basis, but more on a relative basis. When we look back, let's say from 2022 to the current, tech underperformed in 2022, and that was a period where the earnings momentum was actually moving lower relative to the overall market. Since that period, over the last 3 years, tech earnings have been moving up at an accelerating rate relative to the overall market. That's gone hand in hand with outperformance. So right now, partly why we're still positive is that earnings momentum is continuing. I mentioned earlier, again, over the last 3 months, we're seeing the forward earning estimates for tech, even with all this uncertainty, up about 12%. The S&P is up around 5%. So what gets us more negative on the sector is if we start to see that earnings momentum really slow down in a meaningful way. Obviously, the news from Microsoft today is not great, but I think we have to be careful that we don't over-extrapolate each headline either. And at this point, in this kind of macro backdrop, which still has a lot of uncertainty, as we saw with the ADP report, I would say it's hard-pressed to find a sector that has stronger fundamentals.
You mentioned the ADP report, and that, brings us to the consumer and to retail. If the labor market is getting weaker, do you worry about those earnings margins? Do you worry about the U.S. consumer? And could those things break before, tech dominance?
Yeah, as a portfolio manager, I'm also a risk manager, and I always have things to worry about. I would say that our base case is this. Our base case is we actually see a modest uptick next year, and that's really premised on 4 main factors. One, there should be some positive tax incentives that is positive for consumers and businesses that hit in the first quarter from the tax bill. We should have moderately lower interest rates, so that's not a game changer, but again, on the margin as well. We also should have, AI spending that continues. And then the other point I would bring up is employment matters as far as the monthly job numbers, but what's probably more important is the 160 million people that are working that they have wage growth above inflation, which is the case today. So we expect that likely continues, and this kind of muddle through continues, but with a little bit of an uptick. And we should have a little bit more clarity even on the tariffs as we move into next year. So again, not a robust environment, but we're looking for actually a slight uptick as we move into next year.
Is that uptick, Keith, enough to lift up consumer sectors? If I look at how the sectors have done year to date, real estate's the worst, but coming in second and third to worst are consumer staples and consumer discretionary. What kind of turn in the economy, or at least not downturn in the economy, do you need to see the more consumer-oriented sectors do well?
Yeah, so it's a great question, and going back.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Van Eck, celebrating 70 years of helping investors stay ahead in a world that never stands still. Visit vaneck.com. Well, Microsoft in focus. That's after the information reported the company lowered expectations for how quickly it can get customers to spend money on newer AI products. We look at their shares are down more than 2.5%. Stocks are lower on the news right now. Mixed. Nasdaq down about 0.4%, 108 points. The S&P 500 little change, down about 6. The Dow up 0.1%. Or 83 points. The 2-year yield, 3.48%. That's down 2 basis points. The yield on the 10-year, 4.06%, and that's down 2 basis points. And the Bloomberg Dollar Spot Index weakening by about 0.2%. Bitcoin rebounding. It's right now up more than 1% at just above 92,000. Macy's shares down about 1%. Its profit forecast for the current quarter, well, it disappointed investors. That kind of overshadowed some solid results in the lead up to the holiday shopping season. And German fashion house Hugo Boss, they forecast a decline in sales earnings next year. It's looking to recover from a challenging period. And finally, ByteDance's TikTok investing more than $37.7 billion to build a data center in Brazil, marking its first project in Latin America. That is your Bloomberg Business Flash. Paul and Tom.
Lisa, thanks so much. I got 2 things to do here. Tim Stanovic, and way too early now. Masters not in yet. I checked.
No, I saw her. She's here.
She's here?
She's here. I saw her.
Okay, very good.
Entourage.
Tim Stanovic with us here. We were talking Santa Barbara earlier. We played Dishwalla. If you're talking Santa Barbara, you got to play Dishwalla as well. Joe's Cafe, is that where you lived in Santa Barbara years ago?
I'm from the Central Coast, 90 miles north of Santa Barbara, San Luis Obispo.
Right.
Still 805 area code, very close.
They don't know what winter is.
My first concert, Tom, you were talking about Toad the Wet Sprocket this morning.
Toad, yeah.
1995,
Yeah.
Toad the Wet Sprocket, 11 years old. My dad takes me to Cal Poly to see Toad the Wet Sprocket.
Very cool. I mean, the scene out there is amazing.
It's amazing.
Describe for our worldwide audience
Well,
the pixie dust north of LA.
So imagine a place where the weather is gorgeous 365 days a year, where you can surf in the morning and then go mountain biking in the afternoon, and nobody actually works.
Yeah, I noticed that.
It's kind of amazing. I will say, when you were talking about Santa Barbara and UCSB, and you know, the real ones know it's Isla Vista is where UCSB is.
Okay.
I was visiting a friend there more than, close to 25 years ago. We were of drinking age at that point, and everybody was getting beer delivered to them on bicycles.
Yeah.
And I was coming from, even though I grew up on the Central Coast, I was coming from college in Central Maine.
He goes to Maine from Santa Barbara.
Yeah.
I would say
Jesus.
one of the worst decisions in my life geographically was that I did go to visit it in the spring, so I thought things were a little nice.
James Camp thinks you're nuts.
I am nuts. I'm completely nuts.
Jermaine, I got to interrupt. We got James Camp on deck here. Quickly here, Tim. Masser. Sometimes, Paul and I, we have a wonderful booking team at Alligator. Tim has to put up with Carol, who says Wednesday. It's Cyber Monday, Charity Tuesday, it's Chocolate Wednesday.
Oh, yeah.
What are you doing today, this afternoon on chocolate?
CEO of Hotel Chocolat is coming on in the 4 o'clock hour. This is a company that was bought by Mars for more than $600 million a couple of years ago. And you know what? He's bringing chocolate.
Oh,
He's bringing a serious dark fix sleekster for Carol.
Yeah, and for me. Okay. And you know what? We'll save some for you guys.
Tim, thank you so much. Greatly appreciate it.
For the morning help.
Great moment there this morning in Santa Barbara. Out in Santa Barbara and in New York, I believe the 10-year yield is the same. James Camp, now Managing Director, Strategic Income at Eagle Asset Management, briefs us this morning. The major houses have a vector of lower interest rates and assume a lower 10-year yield. Do you buy it? To me, it's like consensus right now.
Yeah, good morning. I think the issue is going to be a couple things for the long-term interest rate. First of all, does the market narrative start focusing back on the deficit, which I think it will, and I think it has to. And we saw payroll numbers today, which were light. We're going to continue to have diminished payroll taxes, which are 35% of federal revenues. And so I think if the Fed gets too cute, and I think if the new Fed chair come around May tries to appease, and we get a short-term interest rate through what should be neutral, I think the 10-year Treasury is actually quite vulnerable here.
What do you think our Federal Reserve is going to do next week, and what do you think they should do next week?
I think the will do is going to be cut. I think the numbers and the odds have kind of moved all over the place, but there's some cover today with the bad employment data, which I, by the way, think is a misread of what's actually happening. I think the Fed should stay on hold. I think the inflation data is going to continue to be at 3%. We're in a structurally higher inflation environment, and cutting short-term interest rates is not going to move the labor market because that's not where the issue is.
So why are we in structurally higher inflation?
Trade, tariffs, the labor force having a different sort of dynamic in terms of how they interact post-COVID. A lot of the brittleness of supply chain, I think, continues to be worked out. And I think we have just gotten to a point where because of, I would call the wealth effect, things with equity markets, housing prices, that a swath of this country, unfortunately, is price indiscriminate. And these price indiscriminate buyers, the top 10, 20%, aren't looking at stickers. They're just consuming.
Okay, this is outside consensus. Are you just grabbing a coupon, or can you manage a portfolio of debt to not see price down, yield up?
Yeah, I think, Tom, you can. And in fact, the trailing 12 months has actually been extraordinarily good for fixed income. As we know, once the Fed peaks, which it did last September, fixed income returns look very, very generous. What we do in the interim, tactically, with our active ETFs and our separate accounts, is kind of shed duration a little bit and wait. I don't think we have an unraveling of the 10-year, and the carry is certainly significantly more generous than it has been. 24 of the last 25 months, we've had positive returns to bonds. I think that continues. And I think once we get some slope in the yield curve, we're going to have total return capabilities significantly higher.
Barry Ritholtz on the same page as James Camp. Paul, here's Ritholtz. There is some signal there, but a whole lot more noise than in the ADP report this morning.
James, I'm looking at the I and Go function on the Bloomberg terminal, looking at the returns and fixed income. You guys have actually done pretty well. People want to chat with you guys these days, I guess, because you guys solid high single-digit returns, particularly in taking some credit risk, high yield, leverage loans, that type of thing. How do you think about that part of the market?
Well, I think the credit market in the triple B, sort of double B area where we play is sort of the sweet spot. I'm kind of an Occam's razor investor. I think the simple solution is usually right. And when we have generous yields relative to the yield curve and in some of the higher grade areas, we have to unanchor ourselves from the financial crisis to COVID interest rate environment. That is the anomaly. That's the historic anomaly, not to be repeated. But we have to also realize we've reset the market significantly higher in terms of yield. So we're at a good place. We're at a good starting point. Carry will pay. We'll have interest. And we have the bond math, if you will, now decidedly in investors' favor, where a couple of years ago it was not.
So, I mean, how's the credit quality out there if you are playing in that part of the market?
Anything that's double B rated or higher, the coverage ratios are significantly better than they were even a decade ago. We argue in our corporate credit portfolio that double B bonds are better credit profiles than triple Bs were 10 years ago. So we've re-solidified balance sheets as a function of the low interest rate environment, the largesse of the Fed, et cetera. Earnings are still good, margins are still good, and we're very comfortable in that part of the credit market.
Don't be a stranger. James Camp, thank you so much. Eagle Asset Management, too short a visit this morning. The market is a mess, folks. Like the line that we use is it's red and green in the screen, but that doesn't describe it. Up big, the information comes out with a Microsoft headline. We crater from plus 20 to minus 10, I think it was, or vice versa, in the market. And now I got a flat Dow, almost flat S&P, Nasdaq, the tech thing down 0.4%. The VIX was 16.XX, balloons out to 17 and change, and already has come back to 16.82. So it looks like that last year bet. Very importantly, we had a print of 93,000 on Bitcoin. Bitcoin lifting, it's $1,200 right now. I really don't care, but I know a lot of people really care about Bitcoin. Paul, in the Bitcoin hour with Scarlet Fu. Yeah. I mean, people have a lot of interest in this, don't they?
They do. And I mean, again, we're getting a little bit of a bounce back here, Tom. So we've got it 92. Dave, I talked to Mike McGlone, Miami Mike McGlone, Bloomberg Intelligence commodity strategist. He's just saying, this is a commodity. It's trading like a commodity. When it gets, over its skis, you're going to see a big pullback, and that's what we've seen. So I'm wondering to see where the support is for this thing. So we'll see. But we'll chat about it with the Scarlet Fu.
Gold up $32, $42.54 as well. Great chat on copper earlier, too. I'm ignorant on copper.
Yes.
I mean, I know the cliche
There's
Dr.
industrial
Copper.
demand. That's what I'm told. There's
huge AI demand.
Exactly. So, I mean.
It's got to be.
And, you got to go find that stuff. So there you go.
We'll
metal's higher. Metal's higher.
Say good morning again on all of the ways you listen to Bloomberg Surveillance. We say thank you. 99.1 FM in Washington, particular thank you. Look for the Nathan Hager Hour with Karen Moscow. Earlier in the morning on YouTube. It's building each and every day. Subscribe to Bloomberg Podcasts out on YouTube. Humbled by the response this 2025.
Order filled.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
Good morning, everyone. Quick update here on the state of AI, the best in the planet. Anurag Rana joins us out of Chicago, senior technology analyst, Bloomberg Intelligence.
Order
Anurag,
filled.
Let's just cut to the chase. If sales are a little light at Microsoft or any other company as well, do they have the bandwidth to cut expenses?
Oh, Microsoft is doing that thing exactly for the last 3 years, unbelievably. If you look at their cost structure from FY22 to FY25, their sales grew by 42%, while their headcount grew by just 3%. So they have been maintaining margins even when their gross margin is going down because of the cloud shift. So I'm fairly confident about controlling expenses. But again, when it comes to AI, it's all about top line growth and nothing else.
So again, the news out here today, for the folks just tuning in, Microsoft shares slid after The Information reported that software maker has lowered expectations for getting business customers to spend money on new artificial intelligence products. How big of a news is this to you, Anurag? The stock's off about 2.8%.
So, Paul, when we look at it, one of the things we have said is, nothing's going to go up in a straight line. There is going to be back and forth in this case. One of the other things that we have talked to you almost for over 2.5 years is enterprise IT spending on the non-AI side of it is pretty bad. When you look at consulting companies such as Accenture, when you look at Salesforce, Workday, their entire business is slowing down because people are allocating more funds on the AI side of it. What we are seeing today could be because of two reasons. One is we are still in that lull period of corporate IT spending being weak. And the second, a lot of this AI work requires data cleanup. It is the actual implementation time is so long that it may take some time for people to digest it rather than just buying. It's very easy to buy a ChatGPT subscription, but to include it in an enterprise requires a lot of work.
So just put it in the context of, once again, just give us a sense of where we are in this game here. And if it's a baseball 9-inning game here on this AI evolution, build out, where are we here?
See, when you look at the entire spectrum, we're going to have the build out. So you see early innings of build out, but the bigger money is going to be made when it gets implemented. What's in the inference side? Every company is embedding more and more intelligence in their products, and we are in extremely early innings of that aspect of it.
Anurag, Tom Secunda, one of the founders of Bloomberg, just said to me one day, "Shut up, stupid, and get perplexity." That's the way Secunda talks to me.
I know, it works.
Mr. Secunda just said, "Shut up, Tom, do this." Anurag, I can't live now without my AI. It's changed my life.
Wow.
Does a CFO or a chief engineering officer at a ball bearing company in Ohio, do they feel the same way?
No, I think that is going to be the same for everybody. When it comes to using AI tools on cloud, just like what you said, whether it's ChatGPT, Gemini, or any of the other tools, I think a large portion of the population is doing it. But the second piece of the aspect is whatever is your core application, it's a banking application. It could be the search engine that you use to run any other operation that gets embedded with intelligence. That requires a lot of plumbing and work of cleaning up the data, figuring out the context, figuring out logic, who has the right access to it.
Sometimes I feel like throw my hands up in the air. I know I can
Order
count
filled.
on you. Sometimes I feel like saying, Lord, I just don't care. But you got the love I need to see me through. Sometimes it seems the going is just too rough, and things go wrong no matter what I do. Now and then it seems like life is just too much, but you got the love I need to see me through. When food is gone, you are my daily need. Oh, when friends are gone, I know my Savior, the love is real. You know it's real. 'Cause you got the love, 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 you got the love.
Order filled. Order filled. Order filled.
It's my heartbeat, and you know I only feel it for you. This song keeps your eyes on me. I hope you see this rhythm is my heartbeat, and you know I only feel it for you. This song keeps your eyes on me. I hope you see.
Order filled. Order filled. Order filled. Order filled.